Hi, everybody, and welcome to this week's Middle Class Investor. This is Seth Martin, your host. It is about 4 o'clock on October 29th, Sunday, and haven't done a program here in the last couple of weeks, mainly because there's nothing new to say. The market is kind of finishing out its last set of waves, I think, in this most recent run-up since the Trump election, and I'm gonna talk about these various channels that I have drawn on the chart, and we're gonna discuss kind of what's likely to happen in the market going forward here in the next few weeks to a month and a half or so. I just want to get you prepared for the potential carnage that we could see in this market, not only in this market but in the bond market, which we're going to talk about in a minute. And I'm going to later on in the program, I'm going to pull up some Elliott wave reports, and we're going to look at some data, some internal data of the market, and we're going to look and see how it compares with other times in history, and somehow we're going to fit all that in here into about 20 or 30 minutes. So strap in, and let's go ahead and start looking at it. So what we've got here is we've got the chart. This is the market. This is the S&P 500 since the 2009 low, and I'm going to go ahead and extend this back a little further. I'm not going to change it any. I'm just going to extend it back so that we can tell that we're talking about the trend since the 2009 low. So this green channel here is the trend since 2009. Now, the way you draw these trends is you find the wave 2 low, which is right here, and you find the wave 4 low, which is right here, and then you expand the channel up to the prices on the wave 3 high. And what I've done is I've done that on this long-term channel. I did it on a shorter-term channel here, you can see in blue, and then I did it on another short-term channel, which you can kind of see here in orange, and then I did it on a very short-term channel, which you can kind of see. I may have to zoom in. You can kind of see there in red, which you can't see the channel, but I'm going to zoom in here in a minute. We're going to look at it. Now I have it on a daily. This is a 10-year daily, so we're going to look at a daily. Hopefully I won't forget to switch back to it from time to time. But what I want to do is I want to zoom in on this last bit right here. Let me expand this so we can tell what we're talking about. Well, I better leave it there because that changes the. I'm gonna have to fix that in a second because it's messed up. I just messed it up. So let's go ahead and zoom in on that, and then let me get this and reset it so that it's right on that bottom. But this trend started here, okay? But this is the wave 2 low. So this is wave 1, A, B, C, wave 2 low right here, wave 4 lows right here, and here's the wave 3 high. So you extend this channel up into that area. So let's zoom in on this trend, and you can see how we've been following that channel. But notice in the wave 5, it only gets to the middle. It's only getting to the middle part of the channel. And I'm going to show you here in a second. I'm going to show you where these channels, there's kind of a confluence where the trends kind of converge right in here. So we're going to zoom in a little bit more again. Let's go ahead and zoom in on this red one here and look at it. So here's the most recent 5-wave move up. So you got 1, 2, all this is 3 to here, I guess. And this is 4. And potentially 4 is not over. I mean, you could have down, up, and then down to here could be 4, and then up. But you can see that's kind of the midline of that previous channel that we were looking at. And then here's this red one is, you can see we're kind of headed for the high line of that channel there. And of course we're extended above this orange channel. So we've got kind of a throwover situation on this. I would call this the it's not the intermediate term. It could be the intermediate term trend. This could be the more shorter term trend. And then then that blue one could be like what Elliott calls a primary wave degree trend. So right here in this area that I've got, and we could probably make this bigger, but we've got kind of a confluence of trends happening right in this area. So what we want to look for is we want to look for kind of a significant break of this trend right here. So, if we see something, and this is going to be our clue to get out, if we see something, a good break below, this low right here, which is right here, then that's likely a trend reversal, okay? And this is the way, Elliott wave works. You get this, this is what I mean by fractal. The market's a fractal. So you have a 5-wave move in a large degree, and basically you get this 4, 5, 4, 5, 4, 5 until all the degrees of trend have played out. And eventually they get so small, like when you get in here, even if it gets up in here, it might go 4, 5, and then 4, 5, but eventually it plays out, and then the larger degree trend down starts to happen. So, and that's the one I've shown you that goes all the way back. Like if you go to all data, and that's the dangerous thing about this market is it really, in the very least, we're talking about the 1974 bear market started this trend. So you're talking about an S&P of like 50. So I've got a couple of likely areas here. One of them is the 2009 low, and we could go all the way back to the 2009 low, and then maybe even lower, like maybe the 1987 low I have on here. Now this is an arithmetic chart. Sometimes if you look at it on a log scale, it doesn't look as bad. The reason it looks like this on an arithmetic scale is because the money's just, the whole time you're going up, the money's worth less and less and less. So that's why it looks this way. The moves are logarithmic. The moves, in order to grow the same amount, the moves have to be bigger, 10 years from now than they did this year, that kind of thing. So anyway, when you zoom in on this, of course, it doesn't look like this. So let me go back to daily, and let me go to 10-year, then daily. So what we've got here, so if you kind of zoom in on where this little circle is, it's right around 2600, which is about 20 points higher than the market is right now on the S&P 500. Now, we haven't looked at the Dow. We could look at the Dow real quick. Let me move that up and look at Dow. The Dow did not follow through the other day like the S&P and the so you can see the Dow didn't make a new high on Friday, still chopping around. So it's likely to pull itself up kind of where the S&P 500 is. So you might look for the Dow, around 23,560 or so. In fact, let's just put that on the chart. 23,560 is right about there. There's 23,564. So, but there's really nothing to do except just wait for these little subwaves to play out. It might take another week. It might take another 3 or 4 weeks. So the main reason I want to call your attention to it is just to be careful, okay, to be cautious, and I've said this many times, you're trying to play for that last 2-3% and you end up losing 20, and that's just the nature of the market, and don't want to see middle class investors put themselves in that position. So anyway, that's the S&P 500. Let's look at we've spiked in volatility, which I always have trouble finding volatility. There it is, volatility index. So we've talked about how we're kind of coming down to this this apex of the triangle, and that we're likely to spike out of it. You can see that we spiked out of it and pulled back in. And you know, if you draw a line between these two, I would say, you know, next move is going to be probably outside of this downtrend line, and you know, then kind of volatility start climbing. So if you're you know, if you're an option buyer, it's a good time to buy options, long-term options. In fact, I have let's go back to the Dow. I'll show you what I did. And you know, I have no idea whether or not this is going to work, but my feeling is that this is the wave 4 low, as I've discussed. And so a lot of times after you have 5 waves, you get a pretty quick return to the wave 4 low. So you can see it's around 15,000. So what I did is if you go to the trade tab and you put in SPY, SPY is the ETF for the S&P 500. And you can see over here, here's your strikes. So I went out to like March of next year, which is right here, and I bought a 200 strike. So I'll show you which one I bought. I bought this option right here. It shows it for 57 cents. I think that's a little bit, the market's closed right now, so this is not showing, it's not reflecting the correct price. The real price is closer to like $1. So I bought it at like 128, and so I'm underwater right now. I'm down because I bought it last week, the beginning of the week, and of course we had that big rally, so you know, these options lost a little money. But the volatility has also spiked a little bit, which makes them worth a little bit more money. So again, this price doesn't really, this is not really the market price. If you wanted to know the market price, you could go in after 9 a.m., let's say on Monday or Tuesday. 9 a.m., they kind of, the price kind of goes down over the course of the day. So if you're buying, you want to kind of buy like after lunch. But so my trade setup is, and of course those are pretty cheap, that I'm expecting before March for the stock, for the SPY, or for the Dow Industrials, which is the DIA, that's the ETF. I put in the index, but I'm expecting the Dow Industrials to come down here to this 145 here before March. And of course, you know, I'm risking like $2 to make 40. It's kind of that kind of ratio. So it's a high risk trade. I mean, it's not a necessarily what I would call a high probability trade, but if we are in fact at the end of 5 waves, the market should return to this area in pretty short order. So that's for not for very much money, I can make a lot of money if the trade works out. If it doesn't work out, then I don't lose a ton of money, but I lose some. So all right, let's go look at 13-week treasuries. Close that back down. Zoom in a little bit here. You can see that we're staying above this trend line. A lot of talk about the Fed raising rates. That's going to continue. They really don't have a choice. We've talked about some of that here. That the market, the 10-year is going to continue to go up now. We've made a low in the 10-year likely. So let's pull up the 10-year and look at it. You can see here we've broken this downtrend line, and the market's moving up and up and up and up, and it's going to continue to move up. We're likely in some sort of wave 3. Now, that doesn't mean it couldn't pull back to here, okay? So if this is a 1, then you know you're going to have a 2, right? And a 2 could pull back in here to 2.2 or so, somewhere in this white circle, and then rally, okay? So this is kind of the larger degree 1, the larger degree 2, and now you're going to start seeing like kind of a small degree 1, small degree 2, small degree 3, small degree 4, so on and so forth. And as the market uncoils or continues to fractal outward, these moves get bigger and bigger and bigger. Okay, it doesn't mean it's still going to look choppy. It's just that larger trends are going to begin to unfold. All right, so that's the 10-year Treasury. We're going to look at the countries here in a minute in a different chart. I think I have it up, so I'm not going to spend a lot of time on the countries. let's just take a quick look at. Whoops, that's not what I wanted to do. Huh. There we go. That's what I wanted to do. And then go to chart, and then open this side up. So here's the Euro US dollar. As you know, we've been following this. Let's put it on weekly. This particular market's really frustrating me because I actually got in like right in here, but then got stopped out. I've been holding my stop really close just because sometimes it whips back on you. And woke up. One of the challenges with this market is it trades, during while you're sleeping. So, if you put in a trade and you get stopped out, you don't have an opportunity. You're sleeping, so you don't have an opportunity to get back in. So I kind of missed this latest move here, which is kind of a big bummer. So I'm probably gonna have to wait until whenever it stops. It'll probably stop somewhere around here in this 1.14 area, and then bounce maybe back up into here, and then maybe I'll get another shot at it at 1.18 or so. So that's the euro. And the euro, the longer term, the euro is going to come down back down here to this 102, 103 area. The British pound US dollar, we've been talking about that market, and I think it's still selling off here. We've talked about what this for the longer, or let's call it intermediate term. For the intermediate term, the euro is a good short. Once the US dollar, Great British Pound US dollar stops pulling back, to me, the GBP US dollar is going to be a good intermediate term long. So we've talked about this. You can go to the FXB, and you can buy the FXB. I would try to buy it somewhere along this trend line. Let it pull back. Zoom in a little bit here. Let it pull back into this trend line. And then when it starts to bounce, then pull the trigger on it. And that's likely to go up into this area. So you got a pretty good trade for, what is that, 40 bucks or 20 bucks, $20 on 120. So 15% or so. It's not it's not record breaking, but when everything else is going down, that's going to be a pretty good investment. So all right, let's go back over to charts. Let's look at oil real quick. We talked about oil and how difficult it is right now to trade, but it looks like to me oil wants to get back up into this area around $68 before turning back and going this way. Okay, so we talked about when it was down here, it could go here first and then there, or it could go up here and then come down. But it's and I know that's kind of goofy, but when it's in the middle, like right in here, it's in the middle of these two zones, there's really no way you just have to wait until it goes one way or the other, unless you feel really strongly about it going here first and then down here. But when it's right in the middle, you just got to wait for it to pull out one way or the other. Okay? All right. What else do we have here that I want to show you? I think I want to just go, because we've already been talking for about 15 minutes, or I've been talking for about 15 minutes. I think I want to just go to the some of the Elliott wave reports that I have. This one's from November. You can see November of this year, and you can see here this is that last little 5 that we're talking about. And of course, you can see he's got an arrow pointing to the wave 4 low. We've already kind of talked about that, but the thing that's interesting to note about this particular chart is the weakening advanced decline line. Now, the advanced decline line, weakens all the time. I mean, you can see here it kind of weakened, kind of corresponded with this right here. So that you had this weakening here. You had this weakening. You had the market sell-off in 87. You had this weakening here. You had the market sell-off here. You had this weakening that kind of led up to that right through here. So this is kind of an internal that people don't always notice. The other thing that they point out here, which I think is interesting, is when you start the waves. So when wave 1 started, notice the peak of the advanced decline line. When the wave 3 started. So this was the beginning of wave 3. It was the wave 1 of wave 3. This is the lower degree wave 1 of wave 3. So see how it peaked. Now it's a little bit lower than this one, which is what you would expect, but it corresponds with this next liftoff of the wave 3. And then this one, this is the other low on the, no, I'm sorry, this one is. They're saying this one is. This is the other liftoff of the wave 3. So these are 3 degrees of wave 3. This is the larger degree wave 3. This is the next degree down, and this is the next degree down in the liftoff in this whole move. And you can see that the advanced decline line was lower each time. You can see right through here. See, it's lower, and that was the last wave 3 liftoff. Now this was a wave 3 liftoff too, but of another smaller degree. So and you can see that we've been weakening. So this is what happens. The market tends to weaken, industry by industry, group by group, stock by stock, until you're left with just a handful of stocks kind of holding up the indexes, which is what we have. We have the FANGs pretty much holding up the indexes. So I wanted to point that out. Here's another picture of it, zoomed in more. So this is the liftoff of this wave 3 and then 3 here. So it's just a zoomed in version, and notice how it looks the same. It looks the exact same as that larger one, but this is several degrees smaller. So that's the fractal nature of the market. This section discusses non-confirmations on a global scale. So in other words, Europe, what they're saying here is that Europe has been going down for a long time. You can see that here. Europe has been going down, okay? And then, of course, over here, you can see China has got its tops running right through here. So, so in other words, this is like a 1, a 2, a 1, and then we're in 2, and then we're going to have some sort of down, okay? This one to me is interesting because you're hearing a lot about the economy these days. And so here you got real GDP. So in wave 3, and when I say wave 3, I'm talking about the much larger degree wave 3. The GDP average over like an annualized rate of return was over 4%. And of course, here it's like 2.5%, 2.7, I think is the number. Household liquidity. So you can see people had a lot more liquid cash on hand at the top of wave 3 than they do here at the top of wave 5. These are all typical measures that you see at various stages in Elliott wave type analysis. Personal savings. So again, people saved more at the top of wave 3. Now they're invested more and they're more in debt. Federal debt. Now, the reason federal debt is higher is because of these other things, right? So household liquidity, personal savings rate. So this is just the opposite, where debt, you would expect debt to be higher at the end of the trend than you would at the middle, okay? Household debt, same thing, and then you have total debt. So total debt, household debt, and federal debt are all higher now than they were at the wave 3 peak. Okay, real GDP, so again, lower in wave 5. Personal savings rate, we've already talked about that. Federal debt, household debt, okay, we've already talked about those. So that's a little bit more complicated to understand. Now this is interesting because let me zoom in a little bit. Well, I can't. Okay, well that's about as good as I'm gonna be able to do, I guess. So these are the interest rates over the last 70 years. So this is starting in 1946. We had an interest rate low, and he basically kind of breaks it up into 19 bottom years, X number of muddled years, and so on and so forth. And then we peaked in 81, and then we've been coming down ever since. So what you've got is basically 35 years up, 35 years down, and he shows the low here, and that we're bouncing, and we're going to start moving in a direction that looks like this. And you can see here about several years out, this is where we're going to have massive inflation. I mean, when interest rates start moving like this, it's going to be very, very difficult for the country to borrow money. It's going to be, difficult time. So it shows here that that type of movement is out, 19 years, but it doesn't have to be that far out this time around, because remember, things are a little bit different this time. We have a lot more federal debt, a lot more personal debt, and so the willingness to borrow, not the willingness to borrow, the willingness to lend could be withdrawn from the United States much earlier than what you see in this picture. It actually could start, right away it has already started. So we're already a year and a half into this, and if we pull back, I mean, we could be up into this area, just below 8% in pretty short order. So I thought that was interesting. Now this is showing that on the primary scale, we've had throwovers in bond prices. So they had reported this last year where they showed a throwover. And of course, the way a throwover works is once it closes back below, it tends to reverse the whole trend, which is down here. So that's what we're looking for to happen on the bond market. Now, this is interesting. See, it says a setup like 1929. So these are all the 1929 charts. You can see real estate. Let's let me zoom in here. So you can see real estate. You see how it kind of curls and then bounces. And here we got a curl and a bounce. So we're basically like right here in the real estate market. So we have all this coming. You can see we have a kind of a lower low in commodities. So we're basically, this area is like right here in commodities. Okay, so we got commodities crashing. You can see here in bonds, we're basically like right here. So bonds have already started going down, but this is what we have to look forward to, this kind of rapid decline. And then here you can see the market, and this is what the market did in 1929. So of course, this part looks a little different, this part right in here. But this rise to the top, and you can see here, this is a pretty dramatic first move. But the thesis is that we're right here in the stock market. So we've got that coming. So these are very scary looking charts, and I'm not trying to scare you per se, but I want to caution you against just going all in right here and thinking everything's going to be fine, because that's this time is not different. Regardless of what you hear on TV, it's not different. There's still massive amount of credit was created by the Fed, and it is what it is. Now, dividend yields, that's another thing. Oh, dividend yields are low right now, very, very low. And when dividend yields get low, you usually have a top in the market. So you can see here in 2000, this is what's generally considered the real money top in the market. Dividends were very, very low, and then you can see that they kind of rose, and then when they fell here again, that was the top in the market. And of course, as the market sold off, dividends went up. But here we are, we're back almost at the same level we were last time we topped, right here. So dividends the market's not cheap right now, regardless of what you hear in this chart proves it here. This price to book value. You can see here in 2000 it was our highest price to book value, but the interesting thing about this chart, let me scoot over so I can see. Here was the 1929 overvaluation in price to book value, and here we are here. And of course, you know what happened in 2000 when we were priced too high, right? That's what happened. Now this area right in here was like 2008, so we went down, but we're quite a bit higher now than we were in 2008. Not as high as we were in 2000, but that was crazy off the charts high. Probably never see that again. But look how much higher we are now than we were in 1929. So the market is not cheap. Is the point there? Here's a stock market value as a multiple of multiple of annual GDP. Again, if you look the beginning of the 1968 bear market, it was right there. 2000, of course, is high. We're never going to get that high again, likely. But here's where we are in 2017, and notice you can kind of pick out 5 waves here. Whoops. Let me try that again. I don't know. It may not let me draw it because they're too steep, but I'll draw it like this. So you can kind of pick out 5 waves here. See that? It's a little bit of a challenge. So right there, and then down, and then up. So you can kind of pick out 5 waves there. So we would expect this probably to go all the way back down here below the 2009 low. So these are just some interesting charts that you're not going to see on CNBC or Bloomberg or anything like that. This is about PE ratios being high. Margin debt. We talked about this months ago about how high margin debt was, and here it is even higher now. So I'm sorry, this is valuation of S&P company. Here's margin debt right here. So very, very high. Now, pension fund allocation to cash. So pension funds are probably the largest group of investors in the stock market. And what this chart shows is how little money they have allocated to cash. It's a record low. I mean, it's low. So that is not good. That generally is a bad sign. So think of the market as like a boat, okay, a small boat, and normally people are kind of scattered around the boat, and the boat's evenly weighted. But if everybody runs over to one side of the boat, what's going to happen to the boat? The boat's going to flip over, okay? So that's kind of how the market works. And right now you got everybody on one side of the boat, and that is a dangerous situation. So we've talked about this chart before. This is the ratio of mutual fund investors versus money market funds. So this is how much money people have in mutual funds versus money market funds. And the reason, a lot of times you hear about cash on the sidelines. This is a better measure because it shows how willing people are to take risk. So cash on the sidelines by itself doesn't necessarily show. Think of it as like a ratio of risk. So if I could have $1 million on the sidelines, but if I only have $5 in money market mutual funds, then that means I'm taking a lot of risk. But if I have I could have equal amounts of cash on the sidelines and in stocks, or call it money market funds and in stocks, and that would be more like right in here, or right in, even down here, like a 1. A 1 is 1-to-1. In other words, 1-to-1 means I've got as much money in money markets as I have in stocks. This means I have 3 times as much money in stocks as I have in money markets. This is 3.8. This is 4.5 or 4.4, and now we're up, right at 5. Actually, this is 4.5, 4.2 or something like that. This is almost 5. $5 in money market funds. Okay, I'm sorry, $5 in stocks for every dollar in money market funds. That's unusually high. This all has to do with passive investing and how people are kind of believing that you can't pick stocks anymore, and so there's a record amount of money in ETFs, which is in and of itself is not bad, but what it says, it says something about complacency and laziness in the stock market. This is an interesting chart here because it talks about buyback. So this is how much companies were buying back at the top in 2000. This is how much companies were buying back of their own stock in 2007, and then here's where we are in 2017. So you've got what's different about this one than this one. These peaks are very similar. There was a lot more money borrowed here to buy back stock than there was here. This is more like taking extra cash on the balance sheet and buying stocks. This is borrowing money at, you know, historically low interest rates, you know, borrowing for 2% and getting a total return on equity of 15%. So buy back stock. That's what the strategy is. But the problem is you still have the debt. So that's what this chart is showing, which is potentially dangerous. Now this is interesting here. I want to zoom in on this one because this data is not everybody knows how to go get this data. Let me zoom out a little bit. There we go. So this can be gotten from the COT data. Let's see, Investors Intelligence. This is from Investors Intelligence. So it's a weekly survey bull-bear ratio. Look how at the peak we are. Okay, so the last time we were this high was at the top of wave 3 here. Okay, and then if you went back here, we were high too in 2007. But you can see that it's not likely that we'll be higher than wave 3. Wave 3 is usually the highest, right? That's usually where the most bullishness is. And you can see that we're almost there. Let me just draw a line straight across here. You would expect the wave 5 bullishness to be lower, but you could see how close we are to the wave 3, which really says something about the market and how close we are to the end of this series of fractal moves in the market. All right, that might be it. These are just other internal measures that are interesting. Record low volatility. I mean, that's amazing too when you think about it. And we've talked a lot about volatility and the record lows and volatility. This is interesting. Speculators' biggest bet ever that the stock market volatility will continue to fall. Can you believe that? You're at record low levels of volatility, and participants are saying it's even going to go lower. Now that is complacency. This has to do with, we talked about it a second ago. It says the public embraces, here, let me zoom in. It says the public embraces the dream of riches from passive investing. You can see how high people, I mean, this is a measure of complacency. Okay, you can see how low they were. You know, just like, what is that? That's not even last year. So I don't know. It's crazy. Crazy times in the market. But that's why we're here. We're here to talk about, you know, what it's going to take to, you know, survive this, basically. And basically, you just have to keep your eyes open and pay attention. This is interesting. This is like this is an interesting chart because what happens at the very end of, you know, they always talk about capitulation. Well, capitulation happens on the upside too. All this is, these are bears and their outlook on the market. Bearish. I mean, look how much bearishness there was, right? And now look, we are here at the very end. We've gone to record level of bullishness by bears. Now that's interesting. Again, that doesn't happen very often. Here's some interesting all-time high auto debt. You can see the 5 waves. All-time high student loan. Now, one of the reasons the student loan, I believe, this is me saying this, doesn't follow this wave structure is because the government backs this. So you'll see this in general on credit expansion of the government. It looks very similar. There's no oscillation to it. And the reason is they just, I guess it's more political or something. There's no social mood associated with it. Here it is, all-time high non-financial business sector debt. So this is what I was talking about. You got companies borrowing money to buy their stock back and stuff like that. This is what I was talking about, the credit. This is another government curve. So you can see it doesn't really respond to these waves because it's the government. The government does things regardless of what the mood is. Historically high government and junk bond debt. So, I mean, debt is just crazy high. Lenders are complacent. These are Covenant Light loans. This is how Covenant Light loans have grown since 2016 and 15 and 14. Back in 2012, Covenant Light loans were way down here, and all they've done is just, now what does Covenant Light mean? Covenant Light means like the requirements for qualification are not very high. That's what that means. Junk Treasury yields, 5th lowest on record. So there's some interesting, internal measures here that are definitely worth noting. And yeah, so this is interesting too. So even here at record low bond values, record high bond values, record low yields, people are betting that bonds are even going to go higher, yields are even going to go lower. It's kind of like the volatility chart. It's amazing. Anyway, that's about it. Just, so what to look for. Let's just talk a little bit about what to look for. Let's go back to, we'll go back to the, I don't know why that's doing that. Just apologize. Scoot that way over. Not that far over. Scoot it over so you can see there. Okay, let's go back to the S&P 500. So I would just look, be really careful when we get up here around this 2600 area. It's only 20 points higher from where we are right now. This looks like this is a lot, but it's not, because I'm so zoomed in. This is August 1st right here. August 1st right here. So this is only about a month and a half worth of time here. So, and then we can zoom in even further and see that right around here in 2600, this move should be over. You might still get, like I said, you might still get a little 4-5, 4-5, 4-5, 4-5. There's like 20 degrees of trend, but they're very, very, when they start getting to that small, you're talking about intraday movement. You're not even talking about, a week-long trend. So I would get my spidey senses keyed up for this kind of this 2600 area, because it kind of gets to this blue line here, which was the midpoint of that channel, and it's also the top. It's kind of the top of this channel. You can see where these intersect here. So around 2600, maybe a little higher, but not much more than that. So I would look for an interesting week in the market. Certainly predicting the market with any certainty, on a daily basis or whatever, is very, very difficult. But we're just talking about big trends here, and this thing could turn, tomorrow, it could turn next week, it could turn next month, but we're at the end of a very long-term trend. This trend dated back to at least 1932. So when you have a trend that dates back that far, that means the correction that you get from that trend is going to be substantial. Because in our lifetimes, I wasn't born in 1932. Almost nobody was alive in 1932. So to work backwards from that, to work off some of that trend, we're probably going to go back to numbers that people that that are alive right now have never even seen in the stock market. And I know that sounds crazy, but it's very, very possible. Okay, all right, everybody. Well, thanks a lot for coming in this week. Thanks for listening to my program. Forward it to your friends, family. I don't know. We're fighting such a big battle here that, because people, you just put your money in and just forget about it. And, that's such a big battle that we're fighting that it's really hard to, get your friends and family and people and talking in circles to actually believe that something like this could happen. Most people think the Fed has this all under control. They run the economy. None of that stuff is true, okay? It's just an appearance. It just appears to be that way. But, a fiat currency, an unlimited way to borrow money, these things help them. These are tools they use to help it appear that way. But there's always a reckoning. If you can't do it in your own home, if you can't borrow money, if you can't go out and borrow half of what you spend every year and just keep rolling it over, then neither can the government do it forever. So that's what we're talking about. Okay? All right, until next week, take care, everybody, and have a happy and safe Halloween. If you got children, keep them close, keep them out of the street. Be careful. There's kids can get in all kinds of trouble. So be careful, everybody. Take care. Bye bye.